A typical organization deals with a lot of data and transactions every day. To run the organization effectively, it needs a system to help collect, organize, and store the data and communicate it in an understandable manner to its users. Now, the aim of this subject is to enable our students to understand accounting information systems and financial analytics from an accountant's perspective. So in this lecture, you will be introduced to basic concepts of accounting information systems and transaction processing. So at the end of this lecture, you should be able to define accounting information systems and its role in a business organization, as well as describe the general model of accounting information systems and its components. You should also be able to explain the broad objectives of transaction cycles in an organization and the relationship between traditional accounting records and computerized accounting records. And last but not least, you should be able to identify the differences between batch and real-time processing and the impact on transaction processing. Now, the understanding of these basic concepts will hopefully lay the foundation for the latter topics on internal controls in information systems, as well as for the revenue and expenditure cycles. So let's look at accounting information systems and its role in business organizations. We begin the study of AIS with the recognition that information is an important business resource. The pyramid in Figure 1-1 shows a business organization divided horizontally into several levels of activity. At the base is the business operations level, where operations personnel need information to support the day-to-day operations. Now, this information is usually highly detailed, such as the sale and shipment of goods, transfers of resources from one department to another, etc. The vertical flow distributes information downwards from senior managers to junior managers and operations personnel in the form of budget information and other instructions. In addition, summarized information pertaining to operations flows upwards to managers of all levels. Management uses this information to support its planning and control functions. Now, the third flow of information represents exchanges between the organization and users in the external environment. These include customer sales and billing information to customers, who are the firm's trading partners, and financial statements to shareholders and ACRA, who are the firm's stakeholders. Hence, in summary, the role of AIS is to meet the following information objectives. Firstly, it is to support the stewardship function of management by reporting its activities to external users and internal managers. It is also to support management decision-making, where managers can use such information to assist in planning and control decisions. And lastly, it is used to support the firm's day-to-day operations, where operations personnel use information for efficient and effective discharge of daily tasks. The information system accepts inputs called data or transactions. Transactions fall into two classes: financial transactions and non-financial transactions. Now, a financial transaction is an economic event that affects the assets, liabilities, and equities of the organization, or what we know as the elements in the accounting equation. Now, there is a dollar value attached to financial transactions, examples of which include sales of products to customers, payments of utilities, or the receipts of monies from debtors. A non-financial transaction relates to all other events that occur in the business but do not affect the accounting elements. Examples include changing a customer's address and credit limit, etc. Although it is not a financial transaction, it is an important piece of data for processing financial transactions, and that is your customer's future sales transactions. Now, do note that data, whether it be financial or non-financial transactions, are facts which have no direct impact on the user's actions. For example, a credit sale transaction. Information, on the other hand, is processed data that is used by users to take an action and/or make a decision. For example, the sales report by region will trigger the sales manager to take appropriate actions on the regions with low sales. Hence, an information system is defined as a set of formal procedures by which transactions or data are collected, stored, and processed into information, and then distributed to both internal and external users for decision making. The accounting information system is a specialized subset of an information system in that it processes financial transactions and non-financial transactions that directly affect the processing of financial transactions. Now, the AIS is composed of three major subsystems. Firstly, it consists of the transaction processing system, which supports daily business operations with numerous reports, as well as documents for users throughout the organization. There's also the general ledger, or what we call the financial reporting system, and this produces financial statements such as the balance sheet, the income statement, as well as the statement of cash flows. Now, the management reporting system provides internal management with special purpose financial reports and information needed for decision making, such as budgets and responsibility reports. So let's see how an AIS works. In this slide, the pink rectangle represents the AIS. The AIS operates within the business organization, which is represented by the blue rectangle. Outside the blue rectangle is the external environment. Now, data sources are financial and/or non-financial transactions that enter the AIS both externally and internally. External financial transactions, like this, are the most common sources of data in a typical organization. And some examples include the sales of goods and services, the purchases of inventory, and the receipts of cash. Internal sources, on the other hand, or transactions, involve the exchange or movement of resources between departments within an organization. And some examples include the transfer of goods from one department to another. Now let's look at data collection. Data collection is the first stage of the AIS, and it's an important one as it ensures that data entering the system are valid, complete, and free from errors. Now, should errors occur in the data collection stage undetected, the AIS may process the errors and generate erroneous and unreliable output. So in designing data collection procedures, it is important to consider two things: relevance and efficiency. Relevance here refers to capturing only data that ultimately contributes to information that the user needs. Efficiency, on the other hand, refers to collecting the data only once, which can then be made available to multiple users. Once data is collected, it usually requires processing to produce information. Now, tasks in data processing include the use of some kind of algorithm, statistical techniques, or it could just be posting and summarizing procedures. The organization's database is a physical repository for financial and non-financial data. In a database, there are many types of files, such as customer files and vendor files. Now, there are many records in a file. For example, if the organization has 100 customers, it is expected to have 100 customer records in the customer file. And each record contains a complete set of attributes of a single occurrence within the file. For example, a particular customer's name, address, and account balance are data attributes to a single occurrence or record within the customer file. Now, database management here involves three basic tasks: storage, retrieval, and deletion. The storage tasks assigns keys to new records and stores them in their proper location in the database. Retrieving means locating and extracting an existing record from the database for processing. After processing is completed, the storage task then restores the updated record to its place in the database. That is why the arrow linking database management and data processing is two ways. Deletion is the task of permanently removing records from the database. Information generation is the process of compiling, arranging, formatting, and presenting information to users. And information can be an operational document, such as a sales order, a physical report, or simply a message on the computer screen. Now, the output can be for external or internal users. Finally, feedback is a form of output from users, both external and internal, and this is sent back to the system as a source of data to initiate or alter a process. This slide contains a summary of what we have discussed in the earlier slide on each component of the general model for AIS. Let's see if you've understood what you've heard so far. Try the question ahead. Now let's move on to the objectives of transaction cycles in an organization. Earlier we mentioned that accounting information systems is composed of three major subsystems. 1, the transaction processing system. 2, the general ledger and financial reporting system. And 3, the management reporting system. So what we will do now is to examine more on the transaction processing system. Now, a transaction processing system processes financial transactions, and your financial transactions are your most common business events that happen on an everyday basis. Now, in order to deal with them efficiently, because there's so many of them, businesses will group similar types of transactions into what we call transaction cycles. And there are three main transaction cycles in a business, and they are the expenditure cycle, the conversion cycle, and the revenue cycle. Let's look at these transaction cycles in a little bit more detail. The expenditure cycle includes business activities relating to the acquisition of materials, labor, and fixed assets, and the related payment transactions. So this includes anything to do with operating and capital expenditures. The conversion cycle includes business activities relating to the planning, scheduling, and control of products through the manufacturing process and the flow of cost information. And you will deal with this a little bit more in cost and management accounting, so we won't be looking at the conversion cycle. However, you will need to know the revenue cycle, and this includes business activities relating to the sale of goods and services to customers and the related receipt transactions. So anything with regards to collecting the money from your customers, your debtors, to your sales of your goods and your services to your customers will be found in the revenue cycle. Business activities begin with the purchase of goods in the case of a trading business, or the purchase of materials in the case of a manufacturing business. Now, the purchasing or the accounts payable subsystem within the expenditure cycle records the order placed with suppliers. It takes on goods received from suppliers, and it creates the accounts payable to be paid later. The cash disbursement subsystem authorizes the payment, disperses the cash to suppliers, and records the transaction by reducing the cash and accounts payable accounts. The payroll subsystem records employees' salaries for services rendered to the organization. Now, it is a separate subsystem due to its unique accounting and legal requirements. In Singapore, organizations need to consider employee and employer CPF contributions, income tax regulations, work permit levies for foreign workers, amongst other things. The fixed asset subsystem records transactions pertaining to buying and selling of fixed assets. Now, the conversion cycle is only applicable to manufacturing businesses. So we're going to be skipping this conversion cycle because it's not included in the syllabus. However, we're going to be talking about the revenue cycle. Now, firms sell their goods and services to customers through this revenue cycle. The sales order processing subsystem processes tasks such as preparing sales orders, granting credit, shipping products to customers, billing customers, and recording the transactions in the accounting books, like updating accounts receivable, inventory, and sales. This cash receipts processing includes collecting cash, depositing cash in the bank, and recording the cash receipts in the accounting books by reducing the accounts receivable accounts. And we will cover more on the revenue cycle and expenditure cycle in lectures 3 and 4 respectively. So let's look at the relationship between traditional accounting records and computerized accounting records. As the transaction processing system captures and stores financial transactions, it is necessary to understand and identify the differences in the accounting records kept in both a manual system and a computerized system. We will also examine the purposes of each accounting record. Now, documents provide evidence of the transactions. Source documents are used to capture and formalize transaction data that the transaction cycle uses for processing. So, for example, sales orders, which are prepared in duplicate copies, are the source document to show that a sale has occurred. Now, the sales orders are entered into the sales order system and are used to convey information to various functions such as shipping, billing, and accounts receivable. Product documents are the documents produced after transaction processing. For example, once the credit sale transaction has been processed, the invoice to the customer is the product document. Turnaround documents are product documents of one system that become source documents for another system. For example, the invoice that is sent to the customer contains two portions. The top portion is the actual bill, and the bottom portion is the remittance advice. When customers remove the remittance advice and return it to the company, along with a check payment, the remittance advice becomes a turnaround document. Now, do take note that documents are similar in both manual and digital accounting records, except that product documents are generated in a computerized system while manually prepared in a manual system. You have learned in FA1 that from the source documents, financial transactions are first recorded in journals and then posted in ledgers. Now, in computerized accounting systems, they store data in 4 different types of digital computer files. Transactions entered into the TPS are stored in a temporary file called a transaction file. The transaction records in this file are used to update data in the master file. Sales orders, sales invoices are examples of transaction files. The master file contains account data. The general ledger and AR subsidiary ledger are examples of master files. Data values in master files are updated by transactions from the transaction file. Reference files store data that are used as standards for processing transactions. Examples of reference files include the GST tax table, or price list, or the approved vendor list. The archive file contains records of past transactions that are retained for future reference and form an important part of the audit trail. Examples of archive files are past year journals and prior year ledgers. Let's move on to the differences between batch and real-time processing and its impact on transaction processing. In this final section, we're going to be looking at 2 models of how transactions can be processed, namely batch system or real-time system. In batch processing, it involves the gathering of transactions into groups or batches, and we process them as an entire batch in one single event. In real-time processing, these systems process individual transactions continuously as they occur. Now, in selecting a data processing mode for a system, system designers must consider several factors, including the trade-off between efficiency and effectiveness. Let's take a look at the characteristic differences between batch and real-time processing in the areas of information time lag, resources needed, and operational efficiency for each of these methods. Now, in the batch processing for information, you realize that there will be a time lag because we will wait to gather all the various transactions before actually processing it, unlike in the real-time method where there's no time lag because immediately upon processing, it is recorded and therefore it is actually stored in the database. With regards to resources, for batch processing, you require actually fewer resources because you're handling everything in one transaction. And more resources are actually required when you're doing real-time processing. For operational efficiency, on the other hand, with regards to batch processing, it actually kind of improves operational efficiency because we don't have to wait for each transaction to go through before it is updated. It gets updated all at once. However, if you're dealing with large volumes of transactions and you're doing real-time processing, it can create some inefficiencies because you're constantly updating your data, and therefore you're going to have to wait for these updates before it can come on. So when immediate access to current information is critical to the user's needs, then real-time processing is your logical choice. For example, in a company where there are dozens of sales locations with point of sale systems which are connected to your same central system, real-time processing is critical to ensure that information on product availability is up to date when your sales are made. However, in cases where the time lag in information doesn't quite affect my user's performance, or having up-to-date performance data is not important, then batch processing could be a better choice. For example, the update to the general ledger system, which is usually done in batch processing mode. Well, congratulations, you have just completed Lecture 1. Let's revisit some of the key concepts learned in this lecture. We've identified information flows in an organization and provided definitions for information systems, accounting information systems, and the role of accounting information systems within an organization. We've also identified the difference between financial and non-financial transactions, between that of data and information, and we've also taught you to differentiate between files, records, and data attributes. In the general model of AIS and its components, we've identified that its components include data collection, data processing, database management, and information generation. Typical transaction cycles include the expenditure cycle, the conversion cycle, and the revenue cycle. We've also touched on manual versus digital accounting records, and we've found that they're not that different after all. And we've also identified batch versus real-time processing in transaction processing. And that concludes Lecture 1. We hope you've enjoyed this lecture, and we hope this helps you in your tutorials.